72 hours. That's reportedly how long remains before BRICS nations activate the first phase of their new gold reference payment settlement system, according to announcements emerging from their latest summit proceedings. Not theoretical, not years away. Imminent activation, if summit communications are accurate. And if you think a gold-backed alternative to the dollar payment system doesn't affect you personally, I need you to understand exactly what's at stake. Because this is not just about international finance. This is about the fundamental structure that has supported American purchasing power, American living standards, and American savings for the past 53 years. The system that allows the United States to import more than it exports, to run deficits without immediate consequence, to print currency that the world is forced to hold. That system is facing its first serious structural challenge since 1971. And most Americans have no idea it's happening. While Western media focused on domestic politics and celebrity news, representatives from nations controlling over 40% of global population gathered to finalize details of a payment infrastructure designed explicitly to function outside dollar dominance, not secretly, publicly, with press releases and official statements. Russia, China, India, Brazil, South Africa, joined by Iran, Egypt, Ethiopia, Saudi Arabia, and the UAE, countries representing approximately 46% of global oil production. 40% of global gold production, over 35% of global GDP when measured by purchasing power parity. These aren't marginal economies making symbolic gestures. These are strategic powers executing a coordinated plan years in the making. And the plan has a specific mechanism, gold, not a return to the classical gold standard, something potentially more disruptive. A trade settlement system where gold serves as the neutral reference point between currencies, where nations can conduct commerce without accumulating dollars, where American financial sanctions lose enforcement power. The implications are significant, and the timeline appears to be accelerating. Now, let me be precise about sources before we continue. I'm drawing from official BRICS summit communiques, central bank statements from member nations, reporting from Reuters, Bloomberg, and Russian state media, and analysis from institutions, including the IMF and World Gold Council. Some details remain unconfirmed. Implementation timelines are subject to change. International diplomacy rarely proceeds exactly as announced. What I'm presenting is the documented trajectory of developments, the historical pattern these developments mirror, and the potential implications if current plans proceed as indicated. This is not speculation. This is connecting publicly available information that most Western coverage treats as isolated stories rather than coordinated strategy. When you see the complete picture, the implications become harder to dismiss. By the end of this video, you'll understand exactly what BRICS is building, how gold functions in their alternative system, and what historical precedent tells us about reserve currency transitions. Because here's what most people don't realize. This exact transition has happened before multiple times to every reserve currency that ever existed. The pound sterling, the Dutch guilder, the Spanish real. Each dominated global trade. Each seemed permanent. Each was replaced when circumstances aligned against it. There's a documented pattern here. A pattern that predicts not just the transition itself, but the timeline, the mechanisms, and the consequences for ordinary citizens holding the declining currency. Same stages, same institutional behaviors, same devastating outcome for those caught unprepared. And the evidence suggests we may be witnessing stage 3 of this transition right now. The only question is whether you'll understand what's happening while there's still time to position appropriately, or whether you'll be asking afterward why nobody explained what was clearly developing in plain sight. Stay with me. The next 15 minutes could reshape your understanding of global finance. To understand what the BRICS gold system actually represents, you need to understand how reserve currency transitions work, not the simplified version, the actual mechanism that's operated consistently for 5 centuries. Every reserve currency transition in modern history has followed a precise 4-phase pattern. This isn't theory. This is documented monetary history, verified through academic research spanning the Dutch Golden Age to the present. Phase 1, alternative infrastructure development. Competing nations begin building financial systems that do not require the dominant currency, new payment networks, new settlement mechanisms, new reserve assets. This development happens quietly, over years or decades. The dominant power dismisses it as impractical or insignificant. This phase typically lasts 10 to 20 years. Phase 2, institutional adoption. Major nations begin conducting significant trade through alternative channels. Bilateral agreements bypass the dominant currency. Central banks diversify reserves away from the incumbent. Volume grows, but total share remains small. The dominant power notices but remains confident. This phase lasts 5 to 10 years. Phase 3, acceleration and critical mass. This is where transitions become visible. Alternative systems reach sufficient scale to be self-sustaining. Network effects compound. Nations that hesitated join to avoid isolation. The trickle becomes a stream. The dominant power attempts countermeasures, often accelerating the transition. This phase lasts 2 to 5 years. Phase 4, tipping point. The transition becomes irreversible. The dominant currency loses critical mass for international settlement. Demand for the currency falls structurally. Currency values adjust, often dramatically. Inflation in the former dominant nation accelerates. Living standards decline. And everyone asks the same question: how did we not see this coming? The answer is always the same. They were watching the headlines, not the infrastructure. Now let me prove this pattern is real. 3 examples. 3 reserve currency transitions. Same mechanism, same outcome. 1914 to 1944. The pound sterling to dollar transition. For over 200 years, the British pound was the center of global finance. International trade settled in sterling commodities priced in sterling. Central banks held sterling reserves. London was the world's banker. At its peak in 1913, over 60% of global trade was denominated in pounds. The Bank of England set global monetary policy. Sterling was stability itself. Then came World War I. Britain spent enormous sums defending its empire. Government debt exploded from 30% of GDP to over 130%. They borrowed from American banks to finance the war effort. They printed currency to cover deficits. But the critical development wasn't the debt itself. It was what happened in the financial infrastructure. American banks, led by J.P. Morgan, began developing alternative settlement systems. New York emerged as a competing financial center. The dollar established independent clearing mechanisms. American exports grew, creating natural dollar demand. Phase 1, alternative infrastructure. Developing quietly while Britain focused on war. By the 1920s, institutional adoption accelerated. Countries began holding dollar reserves alongside sterling. Trade agreements specified dollar settlement. The share of global reserves in dollars grew from negligible to significant. Phase 2, institutional adoption. Still dismissed by British authorities as temporary. The 1930s brought acceleration. The Great Depression crashed confidence in sterling. Britain abandoned gold convertibility in 1931. Countries fled to dollars. The stream became a flood. Phase 3, acceleration. Visible to anyone watching reserve composition data. Bretton Woods. The dollar officially replaced sterling as the global reserve currency. Britain's centuries of monetary dominance ended in a conference room in New Hampshire. Phase 4, complete, officially recognized, irreversible. The transition took 30 years from first infrastructure development to official completion, but the actual shift in reserves happened primarily in the final decade. And British citizens who held sterling throughout saw their purchasing power decline by over 70% relative to gold. The pattern established, the template documented, 1965 to 1979, the gold window and dollar transformation. This example matters because it shows how the dollar itself nearly lost reserve status within a generation of gaining it. Because the mechanism of the challenge mirrors exactly what BRICS is building today. By 1965, foreign nations, particularly France, under de Gaulle, recognized that America was printing more dollars than it could back with gold. The system established at Bretton Woods required dollar-to-gold convertibility at $35 per ounce. But American printing had created far more dollar claims than gold reserves could support. France began demanding gold for their dollar reserves, not all at once, systematically. Ships carried gold from New York to Paris. Other nations noticed. The gold drain accelerated. Phase 1, alternative infrastructure, in this case, simply reverting to gold itself as the settlement mechanism. By 1968, the situation became critical. Private gold demand was separated from official gold through the two-tier system, but central banks continued demanding delivery. The arbitrage was obvious. Dollars exchanged for gold, gold sold at market prices, free money until the gold ran out. Phase 2, institutional adoption of the exit strategy. The acceleration reached terminal velocity. In the first 7 months, foreign claims against U.S. gold reserves grew to 3 times available gold. Nixon faced a choice: let the gold drain completely or close the window. Phase 3, the confidence break. August 15th, 1971. Nixon suspended gold convertibility. The dollar became pure fiat currency. No gold backing, no commodity anchor. Just confidence in American governance. The dollar survived because there was no alternative infrastructure. Europe was still rebuilding. China was isolated. Russia was communist. The dollar was the only game in town. Phase 4, delayed. The transition stalled. But not because the dollar was strong, because alternatives weren't ready. This example reveals the crucial variable. Alternatives matter. The dollar survived 1971 because competitors could not absorb global liquidity. Today's situation is different. China processes more payments than Visa and MasterCard combined through their domestic systems. Alternative infrastructure exists at scale. The constraint that saved the dollar in 1971 may not exist in 2025. Section 8. Historical proof, number 3. 1992 to 1999. The euro launch. This example matters because it demonstrates how regional currency unions actually form, how political announcements translate into monetary reality, and how quickly adoption can accelerate once infrastructure exists. The Maastricht Treaty of 1992 committed European nations to monetary union. At the time, many analysts considered it fantasy. Sovereign nations wouldn't surrender monetary policy, cultural differences were too significant, the logistics were too complex. The dollar's dominance seemed assured. Phase 1. Infrastructure development began. The European Monetary Institute was established. Technical standards were harmonized. Payment systems were integrated, quietly, methodically. By 1995, institutional preparation accelerated. Central banks began coordinating monetary policy. Exchange rate mechanisms tightened, financial markets adapted to anticipate the union. Phase 2. Visible to markets, still dismissed by many American analysts. 1998 brought acceleration. Exchange rates were irrevocably fixed. The European Central Bank was established. Final technical preparations completed. Adoption became inevitable. Phase 3. The point of no return. January 1st, 1999. The euro launched. 11 countries adopted a common currency overnight. By 2002, physical notes and coins circulated. The second largest reserve currency in history was born in under a decade from treaty to implementation. Phase 4. Complete. Faster than almost anyone predicted. Today, the euro represents approximately 20% of global reserves. European nations conduct internal trade without touching dollars. A significant fraction of global commerce operates in euro settlement. The precedent is clear. Regional currency systems can launch rapidly once infrastructure exists. Political will can accelerate timelines dramatically, and dominant currencies can lose share faster than their holders anticipate. 3 transitions. Same pattern, same phases, same eventual outcome for those holding the declining currency. Now, let me show you where BRICS development actually stands, and why the 72-hour timeline, if accurate, represents a significant milestone. The BRICS payment alternative has been developing since 2014, 10 years of infrastructure building. Technical standards, payment protocols, settlement mechanisms. This isn't last month's announcement. This is a decade-long strategic initiative reaching operational phase. Phase 1. Complete. Infrastructure exists. Let me walk you through what they've built. First, the BRICS Bridge payment system, a digital platform enabling direct settlement between member nation central banks. No SWIFT. No dollar intermediation. Direct currency exchange using blockchain-based verification, currently in advanced pilot phase with reported transaction volumes increasing monthly. Second, gold integration. This is the crucial innovation. Unlike the dollar, which is backed by nothing but confidence, the BRICS settlement mechanism reportedly uses gold as a reference unit. Not a full gold standard where currencies are convertible to gold, a reference system where gold serves as neutral valuation anchor between member currencies. The mechanism reportedly works as follows. When Russia sells oil to China, instead of settling in dollars, the transaction is valued in gold referenced units. The actual settlement occurs in local currencies, but the valuation prevents any single nation from manipulating exchange rates. Gold becomes the honest broker. The neutral reference, the asset no central bank can print. Third, central bank reserve coordination. BRICS nations have been accumulating gold at record pace. China has added over 300 tons to official reserves in recent years. Russia's gold holdings have tripled since 2014. India, Turkey, and other aligned nations are buying consistently. Why would central banks accumulate gold if they weren't planning to use it? The World Gold Council reports that central bank gold buying hit 60-year highs in 2022 and 2023. This is not coincidence. This is coordinated preparation. Phase 2. Institutional adoption is occurring now in public documented and central bank reports. Now, here's where the acceleration is becoming visible. Saudi Arabia, the world's largest oil exporter, has joined BRICS. They've indicated willingness to accept non-dollar payment for oil. The petrodollar arrangement that has supported dollar demand since 1974 is explicitly being challenged. Russia now sells oil to China and India in local currencies. Iranian oil trades outside dollar settlement. Venezuelan oil moves through alternative channels. The share of global oil trade conducted in dollars has dropped from over 80% a decade ago to approximately 60% today, according to industry estimates. The trend is accelerating, not stabilizing. Trade between China and Russia has reportedly shifted to over 90% non-dollar settlement. China and Brazil have established direct currency swap lines. India and Russia settle in rupees and rubles. These aren't symbolic gestures. These are practical implementations. Each transaction builds familiarity with alternative systems. Each successful settlement builds confidence for larger volumes. Phase 3. Acceleration appears to be underway. Now, the 72-hour timeline. According to communications from the latest BRICS summit, member nations have agreed to activate the first operational phase of the unified payment settlement system within days, not months or years. If accurate, this means direct central bank settlement goes live. Initial transaction corridors open between founding members. Gold-referenced valuation begins for pilot transactions. Technical integration with existing national payment systems activates. This doesn't mean the dollar collapses in 72 hours. That's not how transitions work. It means the alternative infrastructure becomes operational. It means proof of concept becomes daily reality. It means the exit from dollar dependence becomes practical rather than theoretical. Phase 3, accelerating toward critical mass. And here's what the data tells us about what comes next. When alternative systems reach operational status, adoption accelerates non-linearly, network effects compound. Nations that hesitated face pressure to join or risk isolation. The share of global trade in alternatives grows not linearly, but exponentially. If BRICS trade settlement grows from current levels to even 30% of member nation commerce within 5 years, dollar demand drops correspondingly. If oil trade outside dollar settlement reaches 50%, petrodollar recycling into treasuries diminishes substantially. What happens when foreign demand for treasuries drops while American deficits continue expanding? Interest rates rise, or the Fed prints. Either path leads to inflation. Either path erodes dollar purchasing power. Either path punishes those holding concentrated dollar exposure. The pattern is historical. The mechanism is documented. The timeline is accelerating. Now I know exactly what some of you are thinking. Let me address the counter-arguments directly. But BRICS nations don't trust each other. They'll never cooperate effectively. Valid concern. China and India have border disputes. Russia and China have historical tensions. Cooperation is genuinely difficult. But consider, they don't need to trust each other. They only need to distrust the dollar more. When America freezes $300 billion in Russian reserves, every nation notices. When sanctions can destroy your economy overnight, alternatives become attractive, regardless of other disagreements. The dollar's weaponization has achieved what diplomacy couldn't, unified motivation to escape dollar dependence. But the dollar is still dominant. These alternatives are tiny by comparison. Also true, today. But the pound was dominant in 1913. The transition took 3 decades, but happened nonetheless. Market share changes slowly, then rapidly. The euro didn't exist in 1998. Today, it's 20% of global reserves. Transitions that seem impossible become obvious in retrospect. But America has the strongest military. We can force dollar usage. Military power did not save the pound sterling. Britain had the largest empire in history. Didn't matter when the math stopped working. And consider, military enforcement of currency usage is called war as America prepared to fight China, Russia, India, Brazil, Saudi Arabia, and Iran simultaneously to force dollar acceptance? The question answers itself. But the dollar has no alternative. Nothing else has sufficient liquidity. This was true in 1971. It's decreasingly true today. China's payment systems process more volume than Visa and MasterCard combined. The euro provides deep markets. Gold exists in sufficient quantity to reference value. Even a 20% reduction in global dollar demand would be historically significant, and 20% is entirely achievable within a decade. But this is just anti-American propaganda. Russia and China are spreading disinformation. The data comes from the IMF, the World Gold Council, central bank reports, and Western financial institutions. SWIFT publishes currency share data. The Federal Reserve publishes foreign holder data. None of these are Russian or Chinese sources. So what does this mean for you? Practically. Specifically. Right now, I'm not a financial advisor. I can't tell you what to do with your money. But I can share what historical patterns suggest and what prudent observers have considered during previous transitions. First, understand your exposure. Most Americans hold nearly 100% of their wealth in dollar-denominated assets. Savings accounts, 401ks, weighted to U.S. equities. Homes valued in dollars, Social Security paid in dollars, fixed income denominated in dollars. If dollar purchasing power declines significantly, concentrated exposure translates to concentrated losses, not guaranteed losses. Risk, there's a difference. But understanding your actual exposure is the essential first step. Second, consider what diversification actually means in this context. True diversification against currency risk means holding assets that perform when the dollar weakens. International equities denominated in other currencies, commodity exposure. Real assets, precious metals. Gold has served as the hedge against currency debasement for 5,000 years across every civilization. It's the asset central banks themselves are accumulating. That's not coincidence. That's institutional judgment about where value is heading. Third, understand that timelines can accelerate. Historical transitions took decades, but the actual repricing often occurred within years once critical mass was reached. The pound's reserve share didn't decline linearly. It held, then broke. The euro's adoption didn't build gradually. It launched, then compounded. If BRICS systems achieve operational success, adoption could accelerate faster than consensus expects. The window for repositioning may be shorter than it appears. Fourth, pay attention to signposts. Specific indicators precede major currency adjustments. Foreign central bank treasury holdings declining oil. Gold purchases by major central banks accelerating oil trade outside dollar settlement, increasing BRICS transaction volume reports. These metrics are publicly available. Watching them gives you advance warning of developing pressures. Fifth, stay informed from diverse sources. Western financial media has institutional bias toward dollar confidence. That's not conspiracy. That's incentive alignment. Banks profit from dollar transactions. Governments need foreign treasury buyers. The motivation to downplay alternatives is structural. Reading international sources, following central bank reports directly, and tracking actual data rather than commentary provides clearer perspective. Drop a comment below. Tell me what you're seeing in global markets, whether you think BRICS represents a genuine threat to dollar dominance or an overhyped narrative. I read every comment. This channel grows through discussion with people who take financial sovereignty seriously. Here's what I want you to remember. The dollar's reserve status isn't guaranteed by divine right. It's maintained by practical utility. When alternatives didn't exist, the dollar was necessary. When alternatives become functional, the dollar becomes optional. BRICS nations representing 40% of global population have spent a decade building alternatives. They're now reportedly activating those alternatives. Not in theory, in practice. You don't have to believe the transition will happen, but you should at least understand that serious nations with serious resources are actively working to make it happen. And you should at least consider what your exposure looks like if they succeed even partially. The pattern doesn't care if you believe in it. It doesn't need your permission. It doesn't wait for consensus. It just unfolds like it has for every reserve currency in history, like mathematics, like gravity. The information is here. The developments are documented. The choice is yours. Thanks for watching The Silent Economy. And remember, the people who navigate these transitions aren't always the ones with the most wealth. They're the ones who understood what was developing, while others dismissed it as impossible. 72 hours. If reports are accurate, the countdown may have already begun.